Imagine walking into a bank and asking for a $20,000 loan. The bank doesn't know you personally. They don't know if you're responsible with money, and they don't know if you'll pay them back. So how do they decide? They look at one number, your credit score. That single number can determine whether you get approved for a loan, what interest rate you pay, and sometimes even whether you can rent an apartment. In this video, I'm going to break down exactly how credit scores work in the United States using simple explanations and everyday examples so anyone can understand it. And by the end of this video, you'll understand how people build 700, 750, and even 800 plus credit scores. Before we proceed, quick disclaimer. This video is for educational purposes only and should not be considered financial advice. Everyone's financial situation is different, so consider speaking with a qualified financial professional before making major financial decisions. First, let's start with the basics. A credit score is like a financial reputation score. Think about it like your grades in school. Your grades tell teachers how well you perform academically. In the same way, your credit score tells lenders how responsible you are when it comes to borrowing and paying back money. In the United States, credit scores usually range from 300 to 850. A score between 300 and 579 is considered poor. 580 to 669 is fair. 670 to 739 is good. 740 to 799 is very good. And anything from 800 to 850 is considered excellent. The higher your score, the more lenders trust you. Let's look at a simple real-life example. Imagine two people applying for a car loan. Sarah has a credit score of 780, while Mike has a credit score of 580. The bank looks at Sarah's credit history and sees that she consistently pays her bills on time. So the bank feels confident lending her money and offers her a low interest rate, maybe around 5%. But when the bank looks at Mike's history, they see missed payments and higher risk. So they may still give him the loan, but at a much higher interest rate, maybe 18%. Both people borrow the same amount of money, but Mike ends up paying thousands of dollars more over time just because of his lower credit score. That's how powerful a credit score can be. Now you might be wondering who actually calculates these credit scores. In the United States, credit scores are based on information collected by credit bureaus like Experian, Equifax, and TransUnion. These companies track your financial behavior. For example, they record when you open a credit card, when you take out a loan, whether you pay your bills on time, and whether you miss payments. All of this information is fed into a scoring model called the FICO score, which is the most widely used credit scoring system in the United States. Think of it like a financial report card that summarizes how you manage borrowed money. So how exactly is your credit score calculated? There are 5 major factors that determine your score. The first and most important factor is payment history, which makes up about 35% of your score. This simply looks at whether you pay your bills on time. For example, if you have a credit card bill due on the 5th of every month and you always pay it on time, your credit score will gradually improve. But if you frequently miss payments, your score will drop. Think of it like trust. If someone borrows money from you and always pays you back exactly when they promise, you'll trust them more and be willing to lend to them again. But if they keep missing payments, you'll lose confidence in them. Banks think in exactly the same way. The second factor is credit utilization, which accounts for about 30% of your credit score. This measures how much of your available credit you are using. For example, imagine your credit card has a limit of $1,000. If you spend $300, that means you're using 30% of your available credit. Financial experts usually recommend keeping your credit utilization below 30%. Why? Because using too much of your available credit can make lenders think you might be struggling financially. Think of it like a gas tank in your car. If your tank is always almost empty, people might assume you're constantly running out of fuel. But if your tank usually stays comfortably filled, it shows that you manage your resources well. The third factor is the length of your credit history, which makes up about 15% of your score. This looks at how long you've been using credit. Someone who has been responsibly using credit cards and loans for 10 years is easier for lenders to evaluate than someone who opened their first credit card last month. That's why closing old credit accounts can sometimes hurt your score, because it shortens the average age of your credit history. The fourth factor is credit mix, which makes up about 10% of your score. This simply refers to the different types of credit accounts you have. For example, you might have a credit card, a car loan, a student loan, or even a mortgage. Having a variety of credit types shows lenders that you can handle different financial responsibilities, but it's important not to take out unnecessary loans just to improve this factor. It's only a small part of your overall credit score. The fifth factor is new credit, which accounts for the remaining 10%. Every time you apply for a new credit card or loan, lenders perform what's called a credit inquiry to check your credit history. If you apply for too many credit accounts in a short period of time, it can make you appear risky to lenders. Think of it like someone constantly asking their friends for money. Eventually, people start wondering why that person always needs cash. The same logic applies when lenders see many credit applications happening at once. Now let's talk about why credit scores matter so much in the United States. Your credit score affects many areas of your financial life. It can influence whether you get approved for a credit card, whether you qualify for a car loan, whether you can rent an apartment, and what interest rate you'll pay on a mortgage. For example, imagine two people applying for a $300,000 home loan. One person has excellent credit and qualifies for a 6% interest rate. The other person has poor credit and only qualifies for a 9% interest rate. Over the life of a 30-year mortgage, that difference could cost tens of thousands of dollars in additional interest. That's money that could have been saved, invested, or used for retirement. The good news is that improving your credit score is completely possible if you follow a few simple habits. First, always pay your bills on time. Payment history is the single biggest factor affecting your credit score. Second, try to keep your credit card balances below 30% of your credit limit. Third, avoid applying for too many credit cards or loans within a short period of time. Fourth, keep older credit accounts open whenever possible, because they help maintain a longer credit history. And fifth, regularly check your credit report to make sure there are no errors or fraudulent accounts. Improving your credit score doesn't happen overnight, but small, consistent habits can make a huge difference over time. Think of it like going to the gym. You won't see results after one workout, but if you stay consistent for months or years, the results can be dramatic. If you found this video helpful, make sure you like the video and subscribe to Simplified Finance, where we break down personal finance, investing, and money strategies in the simplest way possible. Also comment below and let me know your credit score goal. Are you aiming for 700, 750, or even 800? And if you want to learn how to build an 800 credit score step by step, check out the next video on your screen. Thanks for watching, and I'll see you in the next video.